I want to start with your broader take on the markets right now. We got the Dow up 193 points. We're near session highs so far for today. Coming into December, coming into Christmas Eve, there had been a lot of talk that maybe stocks and equities had fallen too far too fast since then, that they've risen too far too fast. What's your take on the markets more broadly right now?
Well, I think, on the one hand, you can say, did the market really deserve to go up 20% from Christmas Eve? And we would say not much has changed. On the other hand, we would say the market shouldn't have fallen as much as it did from early November until Christmas Eve. And if you look over that 3 to 4 month period, really not much has changed. And stocks today sell in line with their long-term average PE multiples. And when stocks sell at average multiples, they tend to be the best performing asset category. And as Mr. Buffett had noted earlier this morning, bonds look expensive relative to their history. So if you have equities that are priced in line with history and bonds that are priced expensive, it makes equities look like the asset class of choice.
You're a value investor. What's your take on tech right now?
Well, it's funny what we call tech. We own a lot of things that the market calls tech. Netflix, Alphabet, Apple. But when we look at those companies, we think of Alphabet as an advertising company, we think of Netflix as a media company, and Apple as a consumer electronics and services company. And I think because these are network effect businesses, because a lot of the spending is not on plant and equipment, but is on R&D and electronic processing, more of the expenses tend to go through the income statement, and we think that makes GAAP income understate the value of these companies. So, like, for example, on Netflix, you could look at that company and say it's selling at 100 times this year's earnings estimate, which makes it look very expensive. Or you could say they look set to add 20 million subscribers that appear to be worth $1,000 each and only have to spend a couple $1 billion to do that. So really it's only selling at about 9 or 10 times the value that we expect them to add this year. On that basis, it looks very, very cheap to us. And it's the same way we used to look at cable TV companies 30 years ago.
It's interesting to hear you say that about Netflix. It's not very often that we have people come on and look at this as more of a value play. But I guess we do have interest rates moving back to levels that we saw earlier last year. I guess what is your long-term view on that, and how does that play into your investment in something like, say, Netflix that does have a lot of debt?
Well, frankly, Netflix does not have a lot of debt. They've got about $170 billion equity market capitalization and only about $10 billion of debt. So it makes them very lowly levered relative to other companies. We like subscription businesses. We think Netflix has been undercharging for their product in order to grow their competitive moat. And the scale of the company today, with the number of global subscribers they have, we think is going to be very difficult for anyone to catch. If Netflix raised their prices to consistent with HBO Now or Sirius XM, then you would see the stock look cheap on a PE basis.